Welcome everybody. I'm Matt Dana of Dana Whiting Law, and I have my partner Trevor Whiting. Good morning, Trevor.
Hey Matt, good morning.
Are you ready to talk a little tax law?
I love talking about tax law.
We know that it's going to be a good subject if Trevor starts to drool all over the table, and we might get him to say a code section or regulation here.
It might happen, the drool, the code sections, it all might happen.
Well, today, Trevor, we're going to talk about a topic that I know that's high up there for both of us. And I'll give Trevor credit. He's been with me for over 15 years, and we've developed 3 words that embodies all of high net worth estate planning, right, Trevor?
That's right.
What are the magical 3 words?
We've got squeeze, freeze, and please.
Wow.
Yeah.
So those,
and they all rhyme.
all we have to do is teach our client those 3 words, and literally they will know all the tools that are available in high net worth estate planning.
And you listen to this video, you'll know what squeeze, freeze, please means, and you'll remember it, and you know our clients remember it, and it's a easy
Trevor,
tool.
I have to say that I think that's really the advantage of our law firm, is because a lot of attorneys want to get puffy and talk about code section and regulations, where we just want to talk about concepts they understand, right. Make these simple words. I think we have to lay some foundation of why we feel that we're experts in this field. I'll talk about myself first, and I'll let you talk about your credentials. But first of all, I've been doing this for over 40 years. Second of all, I'm a CPA as well as an attorney. And third of all, I have a master's degree in NYU, an LLM in taxation. Not to mention, I'm also a charter life underwriter in life insurance and a few other things. But I've been studying tax law for 40 years. Now, Trevor, I'll let you brag on yourself for a minute.
Yeah, I've been, since law school, or before law school, I did an MBA and then went to law school and then did the NYU LLM as well, and studied taxation and estate tax and gift tax and transfer tax, all the taxes we like to talk about. And then I've been doing this with you, partnered for 15 years or so, and with a high focus on these concepts and teaching them to clients, teaching them to other professionals and the public and things like that. So,
well, and I'll also say, Trevor, you have just a phenomenal ability to read a court case or a code section or regulation, and it sticks. Yeah. And I think that's what's really impressive.
Thank you.
When we're really trying to dive into the detail, in some of these concepts. I think our listeners need to understand tax law, when you get up to this high level, it's not necessarily black and white. We have to take sometimes a regulation over here or a court case over here and merge them together to get a result that maybe hasn't been tested. And as we go throughout this video, I think we should try to talk about things that have been tested, that are black and white, and then maybe talk about things where you're getting out there. I hate to use the word shades of gray because it sounds, devious, but there are things out there that aren't code section and regulation,
or that just haven't been, like you say, tested in the tax court or in some of the other courts, where we know for sure that when you do it a certain way that it works, or you do it a certain way it doesn't work.
Yeah, and I think the way the code section works is, we would actually have liability if we recommended a strategy where there wasn't a reasonable basis for it.
That's right.
And so I would say, first of all, we're never going to say anything that's illegal, and we're never going to recommend anything that doesn't have, in our opinions, a reasonable basis. I did a seminar last week up in Sedona, and one of the questions was basically I was talking about estate tax reduction by gifting assets, and talking about the limits of what you could give away and what you have to report. And one of the questions was how's the IRS going to know? Basically asking me, well, if they're not going to know, we're not going to tell them. But that's not our business, is it, Trevor?
That's not. We do the strategies that we believe have a reasonable basis, and then most of those are reported to the IRS. We report them on a gift tax return or some type of return, and so the IRS is going to know about it, and we're going to lay out what our reasonable basis is for taking that position.
Okay, thanks. Trevor, as we talk about the word squeeze, I'm proud to say you and I, we developed these 3 words.
Right.
And now I'm writing articles on it. And when you talk about a squeeze, I'm going to lay out kind of a broad picture, and then I'm going to have you kind of jump into a little bit more detail. But when I think about a squeeze, the way I would summarize it is, Right now, everybody's got a federal exemption that's just south of 14 million. Trevor, what is it, 13?
13,610,000.
See, I told you you'd know that. 13,610,000. That's how much we can give away with no tax consequence, right? And it's a free gift. It's a free transfer. But the squeeze basically is trying to squeeze 18, 19 million into a 13 million. It's kind of like getting down to that girdle. Trevor, do you wear a girdle anymore? Did you give that up?
Not anymore. Okay. Yeah, I've given that up.
All right, so we try to squeeze that 18, 19 into that girdle, and then we're gonna make a gift somewhere. So the elements I'm going to get into was, when you think about this, the question is, first of all, when you talk about gifting, how much can I give? Well, that's the exemption. And then with discounts and valuation things we're going to get into a minute, you're going to get 18 and 20 million into that exemption. So how much can I gift? Who can I give it to? And we're going to talk a lot about giving. We don't like to give to people. We like to give to trusts for different reasons. And you know, those are the, and then, you know, what kind of reporting requirements. But let's talk about, first of all, what's particularly important right now about this, you know, $13 million exemption. What's in the news, and why is this a very important topic right now?
Yeah, the big issue is that this the exemption is scheduled to be cut in half in 2026. So there's an index for inflation, and so every year since 2011, that exemption has crept up a little bit. In 2016, President Trump passed his tax reform and he doubled the exemption, and so that's why we have this historically high $13,610,000 exemption. And we'll get another little bump for inflation next year in 2025, but in 2026 it's scheduled to be cut in half.
Yeah.
And so, you know, the IRS has said, though, that if you use your exemption right now while it's high, then you'll be grandfathered in and you'll lock it in. And so we tell clients that you can use your exemption either at death or during life through these gifts. And so that's where we talk to them about making a gift to a trust like you were talking about.
Yeah, and so when we talk about this, you know, using that exemption, the way you use it is you have to make an irrevocable transfer somewhere. And we'll get in a minute where we're going to make the transfer to, what type of trust we're going to make the transfer to. But what I want to get into is part of this squeeze and getting down into that girdle. I referred to valuation discounts, and elaborate a little bit on how do we get 18, 19 million and convince the IRS it's worth 13 million?
Yeah.
Where's the squeeze coming in?
The squeeze comes in, you know, our one of our best tools, and Matt, I know you wrote an article, you know, years ago about the family limited partnership being the GOAT of estate planning, right? The greatest of all time. And that the family limited partnership, or a lot of times we use an LLC these days, but that entity is what gives us that squeeze. And what I tell clients is, all we're doing is we're trying to say on paper that the client has less than they actually have. Yeah. Right? We're not actually taking assets away from a client or anything like that. And so we structure that partnership with voting and non-voting interests, or a general and limited partners. And when we make an irrevocable transfer of a limited partnership interest or a non-voting interest, then we go out and we actually hire an appraiser to tell us what types of discounts ought to be applied to the value of that non-voting interest. And when we get the report back from that appraiser, they come back and they say, well, one, there's a discount for lack of control because they don't have a vote and they can't direct when distributions are made or anything like that. And two, there's a discount for lack of marketability. That partnership, it's created within the family. You know, we don't have outside investors. It's not listed on the stock market, so there's not a market where you can go out and just sell your interest in that partnership. And so there's a lack of marketability, and the appraiser will say, well, because you can't just go out on the street and sell it to somebody else very easily, then there's going to be a discount. If I was in a partnership and Matt, I was selling you an interest, and the interest you were going to buy says that you can't turn around and sell it without consent of some other parties, and you don't have control and things like that, you're not going to pay me full value for that. You're going to say, well, Trevor, I might pay you, 50 cents on the dollar or something like that. But so those discounts are what gives us the squeeze and make that girdle. And
we got a new name now, girdle.
Yeah, we'll start using the girdle, but we can get that 18-20 million dollars down into what looks like on paper something only worth 13 million that we can gift away.
Talking about the squeeze, you know that in the 90s I had a case that really showed me how valuable family limited partners were. And back in the 90s, it wasn't really a well thought out idea that you could get these discounts. But as it started to emerge that you could claim these discounts for lack of control and lack of marketability, it was thought that you could only do that with things like real estate that really do look like they're illiquid and unmarketable. And so in the 90s, it was thought that you couldn't put stock in a partnership and claim discounts on stock. And I had a case where I had a client that had $1 million worth of Abbott Laboratory stock. And when the stock, I remember it selling for $50 a share. When we started working with this client, it was worth $50 million. By the time the client died, the stock was selling at $90 a share and he was worth $90 million. But we created the partnership and put the stock in there, and when the client did this squeeze technique like you're talking about, and he created these trusts for the kids, and he transferred a non-voting limited partnership interest into these trusts. The client died a few years after we'd made these transfers and we made these gifts, and we filed the gift tax return and we claimed a 33% discount on that. And the IRS came in, obviously audited, because you're talking about a 33% discount now in a partnership that's worth $100 million. We're claiming a $30 million discount on a 40% tax. We're talking about saving that client $12 million. And of course they came in with guns blazing, and as we went through the audit and fought the audit and dealt with the audit, we ended up settling that case for a 30% discount. It was just a very thin shaving. And this was back in the 90s. And that's what prompted me to write the article, The Family Limited Partnership, in my mind, is the greatest estate planning tool of all time. To be able to make 30% of value disappear just like that. And so that's critical part of the squeeze, is this girdle we're talking about. And then just quickly, Trevor, who do we like to make that gift and that transfer to, and then we'll finish up the squeeze?
Yeah, the gifting, we always like to gift into irrevocable trusts. And there's a lot of different types of irrevocable trusts that we'll use, but usually it's some sort of trust that we create, maybe for a spouse, maybe for the children and grandchildren. But we like to give it into an irrevocable trust because that type of trust gives benefits related to asset protection and exemption from estate taxes for future generations.
But it's a multi-generational trust.
It's multi-generational, and so the assets are gifted in, and then when the beneficiaries pass away, it rolls on to the next generation, and so it's multi-generational, a kind of a dynasty type trust that some clients may have heard of, and so we always want to make a gift into those types of trust, and so that we get those benefits as that wealth is transferred down.
Yeah, and Trevor, one of the other articles I'm proud of, I wrote an article called simply Red Box, Green Box. And that article, Green Box, talks about the different types of trust that we can make this transfer into. And so I think this is a great conversation, and I appreciate your time today.
Yeah, thanks, Matt.
We just got into a lengthy discussion of what a squeeze is, and now we're going to talk about a freeze. And Trevor, I want to lay out this hypothetical of this particular client. This would be a husband and wife, and let's just say they have a total net worth of $100 million. And that $100 million, and I'm just doing that to make my math easier, right, Trevor? But we do have a lot of clients that are worth $100 million plus. But those particular clients, they'll usually have it's interesting to me that sometimes these clients are real estate driven, and 80% of the portfolio is real estate. They might be stocks and bond driven, 80% stocks and bonds. But these concepts we're talking about, it doesn't really matter what the asset is. We work with value. The asset may be a value of a business, right? So we talked about earlier in our squeeze video where with this $100 million client, he's going to be able to squeeze, probably 40 million, maybe 45 million into the exemptions between him and his wife. We know the exemptions about 13.6 million a piece. Let's just call it 27 million a husband and wife can give away. In the squeeze we talked about with valuation discounts, the amount we're giving away could be in that $40 million range, right? So we're off to a pretty good start. $100 million client. We did the squeeze technique. We've got 40 million into a green box. We're off to a good start. Now, a lot of people would say, well, that's all you can do. You used up your exemption. There's no more gifting. Go home and just get ready to pay the IRS a big check. But we don't say that, do we, Trevor?
No, we don't like writing those checks.
No. We developed the concept, we call it a freeze. And there again, this is a term that we developed, and it's a term that embodies a couple of complicated strategies that we're going to talk about here. We're going to talk about these two main strategies. We're going to talk about, selling assets to a green box with an intentionally defective green box. So this strategy, you can Google it, it's called an installment sale to an intentionally defective grantor trust. Trevor, what's the acronym for that?
We call it an IDGT.
An IDGT.
IDGT. Yeah.
A lot written out there on this. I mean, we didn't make up the IDGT, but we understand it.
Right.
Right? And then kind of the twin sister to the IDGT is a GRAT, the Grantor Retained Annuity Trust, the GRAT. And we're not going to talk a lot about the GRAT here because we think the IDGT's a lot better, so we're going to spend our time talking about an IDGT. But I'm going to tee it up for you, Trevor, this way. So IRS, after you have used up all your exemptions, it is true you can't gift anymore without paying a gift tax. That is true. But what the IRS is very, very lenient on is I can give away future appreciation in value tax-free. Now let's let that soak away. I'm telling you, you can give away future appreciation in value tax-free. So how long do you think it's going to take this $100 million client, Trevor, to be a $200 million client? How long do you think that's going to take?
Yeah, in our experience, it's 7 to 10 years.
Yeah.
They're going to double.
It's quick,
It's
isn't
quick,
it?
yeah.
The more wealth somebody has, it doubles and triples much quicker. And I think everybody's familiar with the rule of 72. But with the rule of 72, when you're dealing with these bigger numbers, an average guy, if he gets an annual rate of return of 6 to 7%, they're thrilled. With these guys, with their kind of wealth, they don't seem happy unless they're getting into the 20 to 25% rate of return. Right. So their wealth does double and triple very quickly. And we're not going to just sit back and watch them go from 100 million to 200 million and watch their problem get worse. We're going to implement the freeze. And the freeze is going to allow that growth from 100 to 200. That next 100 million, it's going to allow it to be in a green box, tax-free. Is that what we're saying?
That's what we're saying.
All right, tell me how to do it.
So, that's exactly why we call it the freeze. We're going to freeze the value that's counted in the client's estate, right? And so what we're going to do is we're going to use our friend, the family limited partnership, and we're going to have a limited partner interest or a non-voting interest, and then we're going to have our client sell a limited partner interest to one of these green boxes.
He's not gifting it.
Not gifting.
We're not using exemption.
We're
not
did
reporting.
That. We already used the gift tax exemption. And
so he can sell assets to a green box.
But he can sell it, and that's where we pair the greatest tool, that limited partnership of all time, with the greatest revenue ruling of all time for estate tax purposes.
Going to get to the rat.
I might not mention the rat.
Go ahead. I'm going to let you give me a code section, a revenue ruling.
We're going to throw out revenue ruling 85-13.
All right.
And 85-13 says that a client can sell a piece of their, some of their assets, so this limited partnership interest, to an irrevocable defective grantor trust, that IDGT, without triggering any capital gains tax.
Okay, let me get this straight. So you're creating a green box for estate tax purposes is taking assets out of the estate, and you can't give to that trust, but you can sell assets. Now I'm a CPA, Trevor. You're not going to trick me here.
No tricks.
When I sell assets, I'm triggering capital gains. Why not here?
That's the default rule. When you sell assets, you trigger capital gains. But in Revenue Ruling 85-13, the IRS said that client that's making that sale is treated as the owner of the assets that are inside that green box, inside that grantor trust. And so it's like he's selling those assets to himself. And the IRS said, well, if you're selling assets to yourself, that's not a real transaction.
So you have a trust that's recognized for estate purposes, but doesn't exist for income tax purposes.
That's why we call it defective. And you know, clients sometimes like raise their eyebrows when they hear that word, and we say, don't worry, the trust is very effective for this estate tax freeze that we're wanting to accomplish, but it is defective for income tax purposes, meaning it's ignored. And so it doesn't give any income tax benefit. There's no income tax downside, including when you sell assets to that trust, there's no trigger of capital gains.
What a country.
What a country.
Okay, now where does the freeze come back to play then? So what does he have in his estate when he dies?
So because it's a sale, that trust, it might not have $100,000 to pay right now to the client. And so what happens is our client takes back a promissory note.
Yeah.
And so it's an IOU where it says that defective grantor trust owes $100 million to the client.
Yeah, this in our example, you know, we've given away $40 million on the squeeze. Let's talk about doing another $40 million on the freeze.
So we're selling $40 million. The IOU says the trust owes $40 million back to the client. And that we amortize it, or maybe it's interest only, but we make it a regular promissory note, and that promissory note is going to start shrinking in value instead of appreciating.
And that's in the red box.
And that's in the red
freeze.
box. That's the freeze. We've got the appreciating growing assets in the irrevocable trust.
The next $40 million.
And they're going to grow in value, double from 40 to 80 million and 80 to 100 million someday. But what's happening in the red box is that promissory note is being paid down and it's shrinking in value over time.
Yeah, it's a great technique. And then back to what you're saying, this is the installment sale to an intentionally defective grantor trust, the IDGIT.
Right.
Phenomenal strategy. And Trevor, what would you say is the risk level in this strategy?
You know what, it used to be higher, but over the years, these types of transactions have been challenged in tax court. And so these are strategies where we can go to clients and say, you know, we're fairly confident that if we structure it properly, and when we analyze those cases, we see what works and what doesn't work, and so we implement what works with our clients, then we can tell a client, this is a good sound strategy, and as we implement it properly, then we've got a lot of confidence that it's going to work right.
Yeah, and you hit the nail on the head. The payment back to the client, we need to match that with the income the assets are going to generate, and then we can have that flow into the green box and then out to the client. And generally speaking, you know, whether we make that a 20-year note or a 15-year note, what interest rate we put it, and what interest rate we put is really immaterial because we said for income tax purposes it doesn't exist.
Right.
Okay, Trevor, on this freeze technique, so the example we're using in the squeeze, we gave $40 million to a green box, and we got that down into the exemptions. Now we're talking about in the freeze, we sold $40 million to a green box. You took back a promissory note for $40 million. So the next day after we've done this, you could argue we haven't really done anything to shrink the estate further, although we would argue, yes, we have, because we're using discounts and valuations, and right. So we're getting the squeeze. We're using a squeeze on the freeze as well, right?
That's right.
We're selling $40 million to this trust. That's what we report to the IRS, but really on paper we might be selling 50 or 60 million, right?
That's right.
And now I've got $80 million in this green box, and those 80 million, that's stocks and bonds and real estate, and it's generating revenue. Who pays the income tax on that green box?
Yeah, so our client pays that tax. So the person who sold the assets to the trust or who gifted the assets to the trust continues to pay the income tax on it, which is a good thing, right? Because we're doing these transactions because the client has too much wealth. They're above these exemption amounts. And so as we allow the assets in that trust to grow even income tax free because the trust doesn't have to pay that tax, our client pays that tax, and as they pay that tax, their red box shrinks as they write checks to the IRS, and it doesn't change the amount of tax that's going to be paid. And so it's a good result from an estate tax standpoint to have the client continue to pay tax on that.
Well, and the client's got the money to pay the tax because he's getting the payment on the promissory note, and the payments on the promissory note replicates the income he's lost. And I'm gonna put that in as the last advantage of a freeze technique, because in most of these trusts that we set up, one of the forbidden fruits is you can't create a trust, transfer something to that trust, call it a gift, but still retain an economic benefit. You can't retain the income and the use and enjoyment. Well, here we really can. We create the green box, we sold assets to it. We didn't retain an interest. We sold assets. We've got the promissory note coming back.
Right.
So I think it's the best of all worlds.
It is.
Thanks, Trevor. I think I understand it now.
Wipe the drool off the table.
All right. Have a good day. All right. Welcome, everybody. I'm Matt Dana, managing partner of Dana Whiting Law, and I'm here with my partner, Trevor Whiting. Trevor, welcome.
Thanks, Matt.
So we've already done 2 segments. We talked about the squeeze. That was exciting, wasn't it?
We loved it. Yeah.
Got the freeze down.
We loved that one too.
Now, what's this last one we're going to do?
Now we're going to talk about please.
All right,
Squeeze,
please.
freeze, and please.
All right. So, Trevor, I'm not exaggerating, but by the time you do those first 2 techniques, there's only a few things that are left over. I'm just telling you, we've been doing this for a lot of years. The squeeze and the freeze are 2 powerful techniques. And for 99.99% of America, it's going to solve all their problems, right? But that little tiny piece, that $100 million client plus, he may still have something that's red that's going to cause an estate tax. Right. And we were using the example earlier of a $100 million client. With the squeeze, we got $40 million into a green box. With the freeze, we sold $40 million to a green box. And let's just say that client lived for another 10 years. That green box that we gave 40 and we sold 40, that green box that had 80 in it now has 200 million in it. We got that appreciation out. That's green. What he has left over that's red is maybe 20 or 30 million. And so now he's going to die, and he's got this last 20 or 30 million dollar piece that's going to cause a 40% tax. And let's just, for discussion purposes, say he's got, I'm going to say 40 million that's red, 40% of 40 million, he's going to pay 16 million in tax, right? So the first please is just please the IRS. I mean, we fought a good fight. We've got 200 million that's green, right?
We did pretty good.
Did pretty good.
Yeah.
Paying 16 million, not a bad gig, right?
Right.
We wouldn't do that, right? Because we don't want to pay them anything, right? We're tax attorneys. We love our country, but we also love the tax rules, and we know the tax rules, and we don't want to pay if we don't have to pay. So the next please would be the guy that is selling a life insurance policy. And I'm not knocking those guys. I was one of those guys, right? I'm a CLU. I used to sell life insurance for Northwestern Mutual. I understand life insurance, and I do understand there's certain clients it makes a lot of sense. If their estate tax liability is going to be $16 million, all right, let's go out and buy a $16 million life insurance policy, right? Let's put that in the green box. We'll use that to pay the tax, right? And that is a good technique, especially, I would say, Trevor, for an unsophisticated client that doesn't want complication.
And maybe a younger client that's
Yeah.
more insurable, where the insurance is more affordable too.
Yeah.
I mean, there's different factors that'll go into it, and that might be what we decide to do. Is, hey, let's call up the insurance guy and let's write a policy.
Yeah, there's with premium financing now and all these techniques. Yeah, I don't want to say that's not a policy, that's not something the client should take a look at. But if they want to go to a situation where, I really don't want to pay that much in premium, what else you've got? What's the last please out there, Trevor?
Yeah, so the last one is we can please charity.
Yeah.
And when we're talking to clients at this level, they frequently already want to help charity, right? They want to give to charity. They're they've got 200 million in this example set aside for the kids and the grandkids, and they think, man, that's a pretty good amount there. You know, how much do the kids need?
Kids are going to be fine.
The kids are going to be fine. Maybe we can give some more to charity. And so we talk to clients about that, and we tell them there's two primary options. The first one is they can just say whatever piece that is, and we can word the document properly where we just say whatever piece is causing us this issue on the estate tax, that can go straight to, maybe it's a private foundation for that client,
or that client creates their own family foundation.
They create their own.
Dump this $30 million in our example into that foundation, get a charitable deduction, and be done with it.
That's right. You know, or to a public charity. Maybe they have their favorite charity out there. But the private foundation, the family foundation, allows the kids to be involved in that philanthropy and in those decisions year to year going forward. And so, you know, that's kind of the first option. We just give it straight out to those charities. So the second option is to send that charitable component to a washing machine, or what we call a TCLAT, a Testamentary Charitable Lead Annuity Trust.
Maybe we're washing the girdle.
Maybe it's the girdle that's being washed, but with the washing machine, we came up with that because we've got this piece of the estate that's dirty. It's causing us this headache because it's subject to estate tax. And so we run it through the cycle in this washing machine, and the washing machine cleans it of any estate tax liability. And what happens is we take that amount, we put it into this charitable lead trust, and the cycle is usually about 15 years that we set it up for. And over that 15 years, that washing machine is sending payments out to charity. And again, it can be to that private foundation, or it can be out to public charities that we like. But it's sending out amounts to charity each year. But what's left over at the end of the year, after those assets inside of it have been invested and are growing in value and things like that, what's left over comes back to the kids free of any estate tax. And so they receive their inheritance when mom and dad pass away, and they've got that $200 million. But then 15 years later, if there's leftovers in this washing machine, then that's going to come back as a second inheritance back to the kids.
Yeah, so basically you're saying the kids get two inheritances, right? When mom and dad die, we've got the $250 million in the green box already.
Right.
We've got the $30 million that's tainted with estate tax. Throw that into the washing machine. It washes out over a 15-year period, and 15 years later they get the $30 million back.
Right. Yeah.
And what we call that the washing machine? There again, that's our label to make it easy for clients to understand. What's the technical terms if somebody wants to Google this?
The technical term is Testamentary Charitable Lead Annuity Trust.
All right, wipe the drool off.
Yeah, I gotta get that off. But or the acronym we use is TCLAT.
Yeah.
And so you could Google that. You can see it. One of the famous uses of it is Jacqueline Onassis had that in her estate plan. So sometimes you'll hear it called the Jackie O Trust.
Yeah.
But it's a charitable trust that's set up after mom and dad have passed away, that receives that $30 million piece that's subject to estate tax, washes it for that 15-year cycle, and then gives it back to the kids.
Phenomenal strategy. And Trevor, you know that some of our biggest clients have come just from that strategy. One of the biggest clients we have in our firm even today is a client where I emailed him a flow chart of how the washing machine worked. And I just said, I called it the zeroed out estate plan. And I said, why don't we get together for lunch and talk about this? And it was a breath of fresh air. And I think our wealthy clients really like that.
Right.
And the thing is, why isn't Trevor, you know, I always get from clients, well, why isn't everybody talking about this? I mean, speak to that point.
Yeah, you know, these are complicated topics, and you know, which is why we use terminology like washing machine and squeeze, freeze, and please to try to simplify it for our clients. And so not everybody's willing to stay up on top of, you know, how these work and the rules associated with them and things like that.
So you're saying that the people that practice in this high net worth area, it's a small circle.
It's a small circle, and you know, with our education and our focus on this practice area for years. You know, we're very comfortable in that area. We love practicing in that area, and so we enjoy talking to clients about it.
Well, in the potential client pool, this, 99.999% of America won't ever need a washing machine. So
That's right.
I think the fact that the people that practice in there very narrow, the client that's interested in this is very narrow, and I would also say that even people, CPAs, I mean, they're really good at the income tax side, and it's just really good to be good at the income tax and the estate tax side. But everything we're talking about here, people can Google it. These are techniques. I think that, who's the founder of Walmart? Was it Sam Walton?
Sam Walton.
Didn't he use the same technique? And I think the IRS actually challenged it in that particular estate, and the IRS lost.
Right. Yeah.
So there again, on our risk level, what do you say the risk of doing a TCLAD is?
Not very high. It's a mainstream, IRS code sanctioned strategy, and we do it when you do it properly. It's an excellent tool.
Well, thanks for your time today.
You're welcome.
I gotta go get me a TCLAD.
Yeah, go grab a washing machine.
Thanks.